Goeiemôre almal. Is baie goed om in Pretoria te wees by julle. Baie dankie vir julle tyd wat julle aan ons afstaan. Ek het gedink om in 'n paar dinge te gesels in plaas van om 'n lang storie te maak van wat ek aan julle vertel. I've decided to focus on what are the questions I'm most regularly getting from clients and advisors. I've probably had a long list and I picked out effectively two of them that is probably most relevant at this point in time. The one is the question about the rand. That dreaded question about the rand, which we always get. I just want to warn you that I'm not going to give you the answer. If I knew that, I would probably not have stood here, probably been retired somewhere in a tax haven or even in South Africa. Secondly is Prudential's investment philosophy. So Johnny spoke to you about how we think about managing equities, the valuation side. I want to focus on the part where, what does that mean for you and your client? I.e., so what? Right? It can work well for us. Does it work well for you and your clients? I'll try and focus on that because the question I typically get from many guys is, you guys are just hugging the index. I can rather buy a cheap passive fund and maybe put a couple of nice and sexy boutiques around it who's going to add this massive alpha for me. And surely that sounds like a fantastic strategy. I'm not going to go into all the pros and cons of that, but I'll try and give you some view on that. So the dreaded question about the rand. Now, in order to try and see where this is going, I always try and say, right, let's just get back to the facts a bit. And I'll try and show you a couple of things how I look at the world. It may or may not be useful to you at all. Firstly is how much, because when a client asks that question about the rand, it's probably about how much should I take offshore and when? Today, or should I wait a bit or not, type of thing. Right? You guys probably hear that question a lot more than I do. So I firstly had a look at how much offshore exposure has a client got today, a typical client. So what I've used here is a typical South African balanced unit trust fund. Why have I used that? I think it's a good proxy for a client's retirement assets. All right? Probably every client's got his biggest pot of money in a retirement pot, pension fund company, pension fund RAs, and that's roughly invested with the average South African balance fund. So this, different asset classes, this is the actual average asset allocation of all the balance funds in South Africa, right? So this is exactly how all the managers that you guys will probably use, this is the average of how they're invested, and if we have a look at that on a first glance, you would probably think, so this is the offshore part, it translates to about 26, just over 26.6% offshore assets, and if you pick up any balance fund fact sheet, it's probably a number that you would get to. For the clients in the room, these funds are limited to 25% offshore. With rand depreciation, they could typically go over a bit. They've got 12 months to come back. So that's sort of roughly a picture that you guys would probably see on a daily basis. The question is that all there is to it? Now, Johnny has already alluded to the fact that within domestic equity, maybe that answer is not 0% offshore exposure. So if I look at firstly SA property, and I look at all the listed SA property companies, so the SA property index, if I were to take the net asset value of all the underlying properties who are listed in that index, about 30% of those assets sit outside of South Africa. Right? You can use that maybe as a proxy for revenue or exposure. Effectively, the bottom line is 70% of this property, the exposure your client get is SA and 30% non-SA. If I do the same on the all-share index, now Johnny spoke about a top 40 and the SWIX. I did mine on the all-share index. I got a similar type of number. Looking at revenue, where does it come from? Inside or outside South Africa? 44% are inside South Africa. So effectively corporate South Africa, like Johnny has explained, has gone to invest offshore. Many didn't work out well. On average, it actually did work quite well for yourself and your clients. And 56% of the money actually now, the revenue comes from outside of South Africa. i.e. sometimes you hear bad news about South Africa, the rand plummets and the JSE actually goes up. This is maybe one of the explanations. So if I were to plug that 56% non-SA and the property number back into our picture, and we look there and translate what is the effective non-SA exposure, the average balance fund would probably have give and take 50%. Keep in mind, I haven't assumed here within equities a manager may be overweight the rand hedge stocks or not. This is just an average picture. Okay. So your client probably sits with roughly 50% offshore exposure. Is it the best offshore exposure or not? Depending on our companies listed here, you can debate that. More importantly, is that the right answer for your client? I don't know that. You will sit with all the individual details of your client and then you can try and make that call. The only point I'm trying to make here is don't think it's only 25. Right. Then looking at the rand itself, so what I've put up here is the rand exchange rate versus the US dollar. Right. Now as investors we sometimes make these anchoring type of mistakes. Right. We get a number in our head and we try and remember that. So the rand peaked at 1372 to the dollar here, and we've got this 14 rand in our heads against the dollar. Right. The first point I want to make on this slide is the rand should depreciate against the dollar over time at the rate where our inflation rate and the US inflation rate is different. Right, so SA inflation just over 6, US inflation just over 2, it's a 4% difference. So if I take the purchasing power parity fit and I put it on, that's effectively what it says. The purchasing power difference, inflation of a basket of goods, you'll see it should depreciate by currently about 4%. And over time, it has actually done so. But clearly the rand goes a bit on a roundabout around this average. So if I try and put a bit of a band around it, you can try and get a feel for when is the rand very strong at the bottom or when is the rand very weak. So clearly the pain that your clients currently sit with is 5 years ago they were there very strong and now they're very weak within 5 years. Very, very painful position to be in, and therefore, how much should we take offshore? Right. Again, the point that I was trying to make here, in terms of, if you were to take that peak, and the rand peaked at about just below 14 rand to the dollar, as if I try and work out the purchasing power parity of that number, yes, it was a peak number, the equivalent today would have been about 23 rand. Okay. We're not there yet. I'm not saying we're in a good space. I'm saying we're not there yet. It's sort of cheap. But think about, we're not always going to be, or that 20 rand to the pound. All of us had that 20 rand in a pound in our heads for the last 20 years or 10 years. It's probably now a very different number. So if I look slightly at a different way around it, so what I've plotted here on the right-hand slide is the rand, the real exchange rate of the rand, i.e. adjust for inflation, against a basket of our trading partners. Right? What I'm trying to ascertain here is the rand cheap or expensive, not where it's going. Today, cheap at the bottom, expensive at the top. So at 2010, I was spending 4 months in the US. It was absolutely fantastic because I was buying US goods at 7 rand to the dollar and in fact below 7 rand. And I got these emails from all my friends, please bring X along, and Amazon came to deliver and please bring along. Right? If I were to go today, I'm not going to get so many of those emails. So if you look at it, the rand, 20-25% cheap. Can it go cheaper? Absolutely. But on a long term, it's cheap and it has been cheap before. Quick corrections. The interesting thing for me is when I get this question about the rand, I only get the question about the rand. What do I mean? If you were to take money offshore, you selling an asset, exchanging it at an exchange rate and buying another asset. So you may be taking money out of a bank or money market at 6-7%, exchanging it, putting it, let's say, in a US bank account at 1 or 0 or minus 1% or whatever the case may be, right? You need to think about those assets to get the full picture. So the money market ones are easy. I'll take equities on the other extreme side, and you can work out anything in between. So what I've done here is I've put two lines up. It's the valuation of SA equities versus the valuation of offshore equities. So this red line is a price to book. Pick a valuation measure, use price to book here. Of SA equities, again, at this point it's expensive, at this point it's cheap. This yellowish line, MSCI world equities, right? So clearly at this point, world equities very expensive, this slide very cheap. So if I put all of this together, the rand in here, to try and picture the story, selling SA equities, exchanging rands for offshore currency and buying an asset. Now you'll do equities or cash or a balance fund in between. I'll use this as an example. And I'll just take two examples. Seeing that we're currently here at a bit of an extreme position, I'll take these two. So at this point in time, clients were also panicking quite a bit. What happened? So client comes into your office, Mr. Advisor, what should I do? So you were selling SA equities at roughly fair value. You were selling your rands extremely cheap, about 30% cheap. You were buying offshore equities, a basket of at roughly 25% discount. Did that work or not? I took a 3-year view on it roughly. To go offshore, even though you were selling rands very cheap, clients on average made 15% doing that trade on a 3-year view. All right, so it turned out fairly well. In this instance, again, clients were selling SA equities slightly cheap. Not a good thing. Selling their rands 35% cheap, not a good thing. Buying offshore equities 10-20% expensive, not a good thing. You would actually have been better off 120% over 3 years staying in SA, right? So the only point that I'm trying to make here is consider not only the rand, what asset are you selling? Is that cheap or expensive? Is the rand cheap or expensive? Is the other asset you're buying cheap or expensive? Then you try and take all of this together and say, right, should I now take assets offshore together with how much has my client already? Currently, world and SA equities rounded about par. The rand, as we've seen, 20 to 25% cheap. The next thing I wanted to focus on is how we construct portfolios. And I think Johnny has taken you through a lot of this already. So I want to focus on one thing only, this thing called risk conscious. i.e., are we gamblers or are we putting calculated bets together, right? If I were to look at all the stocks in the all share index, there's about 163 of them. I've plotted here the 50 biggest ones. This is their market cap, how much percent of the total index. As some of you may know, hopefully all of you know, when we invest, our portfolio managers have got a stock limit. They can only go 3% over or 3% under a stock. Okay? So again, when many guys ask you, you always have to hold all the stocks because these stocks are big stocks. You will track the index. Effectively, of the 163, only 8 stocks are above 3%. So effectively, all of these stocks we don't have to own. These stocks we will own, right? Varying degrees of them. Why is that relevant to you and your client? If I were to put these weights and the 3% up and down spectrum on a picture, it would look like this. So this would be the weight in the index, where those two colors change. The yellow is our spectrum for over allocation, and the greenish color, whatever that is, would be the underweight position. This is how we would play stock. So why is this important? Sometimes we get it wrong, right? It actually happens often. Asset managers do get it wrong, right? So what happened here? What are the obvious things where you would get it wrong? So Able would have sat somewhere here, a bankruptcy, right? That's the obvious one. There were managers that were 11% in Able, 10 times multiple of what that stock is in the index. You pay us to take calculated bets with your client's money. A bet like that, and by the way, it's very good asset manager in my view, but that one bet can wipe out all your other bets for the year. Take another example, take Naspers, one of the big ones, right? So we'll never own zero of Naspers. If Naspers is 12% of the all share, if you own zero of Naspers, it's a minus 12% bet you've got in your portfolio. It's probably the biggest bet in your portfolio. If you get that one wrong, it probably didn't matter what happened on anything else, right? Why do we hold that? Quality company, and you would want to buy quality companies cheap, but you don't always get that opportunity. Probably with Naspers, you haven't had that opportunity in 15 years. If you didn't own Naspers for 15 years, just that one call would have made you lag the index more than 2% per annum. Compound that, right? Other things, SAB. Yes, we know SAB and AB InBev were talking for more than 2 years about potentially about a merger. When it eventually happened, we were actually underweight SAB. Got it wrong. Stock was expensive, but it didn't wipe out the whole portfolio's returns. There are also other things which you could never guess. No amount of historical data showed any stock analyst what Volkswagen was about to do, right? Things happen. You can't get data on people cheating on emissions. There's no data like that. You can get it wrong. That's why, even though we're confident in the bets, decide how much you're prepared to put this bet on the table and how much money you can lose. So, to give you an example, this would be our current holdings in these portfolios. These would be the overweights. Clearly, some of these stocks here at the bottom, we would own zero or very, very little of them. So we do take active bets with your client's money, but we try and do it on a risk-conscious basis. Now, the question in your mind is probably, can this work? In the end, the client wants alpha, right? Can you add the alpha over time? Which I'll show you just now. Importantly, we've also got the same philosophy on a sector basis. On a sector basis, we go 5% over and under. Within the sector, you can have various bets depending on within that 3% limit. But on the sector itself, 5% over and under. Again, you may get things on resources very right or very wrong. If you sit on 40% resources in your fund and resources triple, you're the absolute hero. If they go the other way, you can probably break your client's portfolio. Over time, does this philosophy work? Can it add alpha being risk conscious? What I've put here, this black line on 100, is the average of the general equity category. All right, that happens to be our benchmark. This is what we compete against. That's the average. What I've also done here is I put all the other market indices on as well. All share index, capped index, SWIX, top 40 as well. All right, I started it when the capped index started in 14 odd years ago. It's the longest data I could go back. Can you add alpha above those indices? Those are our two equity funds. Yes, absolutely you can. I'm not trying to put this on saying, look how fantastic we did. I wasn't there at the time. It took me a long time to see the light for this. I'm trying to show you being risk conscious can add the value. Importantly, when you then take it back to your client, you probably see your client once a year, twice a year. What is the picture what is the ride on this roller coaster that your client can experience? This is a picture of our rolling 1 year alpha. Yes, it's going to be volatile. It is a roller coaster ride. Absolutely good times, 10-year alpha over a year. Worst case scenario, we haven't come to -6 in a given year. Some fantastic managers have added -30% alpha in a given year. Over the long term, they add the alpha. The question is, can the client handle this ride that enables him to stick it out to the end? or is he having a very difficult discussion with you and say, I can't handle this, I need to get out. This minus 30, this doesn't work for me. Taking it over a slightly longer picture, rolling 3-year view, this is annualized, so let's say 2% alpha over 3 years, it's per annum, 2% per annum after all fees. So yes, you don't have to be in the index tracker to stay close to the index. You can do this as well, right? And use this as a big core inside your portfolio. Bringing it back slightly more to you and your client, and I've got a particular interest in behavioral finance. How does clients react with their investments? And you guys are the experts in this. I've looked at a bit of international research. The one place I found some good research is Vanguard, one of the biggest asset managers in the US, in the world. The research that they did came to imply that, let's say you and your client decide you want to invest in equities. Now you pick a benchmark, let's say the all-share index. When you pick managers or stocks, you would get a hypothetical normal distribution of returns around that benchmark at any given point in time. All right? Clearly, if you have a review with your client and you're over this, then client is very happy. If you're slightly under, may ask some questions, may ask more questions, eventually this is the minus 30 in a given year type of discussion, I'm pulling my money. Not only from you, Mr. Advisor, from the asset manager as well. Why is that important? You will lose the client and your assets, but the client doesn't stick it out with that manager, and when he rebounds, he probably doesn't reap the rewards of that. So in the end, the client loses, and I think I've shared a lot of research on that before. If you can find managers that bring that normal distribution closer, again, importantly, must deliver the alpha over time, but can you get a slightly smoother ride? And this is what we would argue, what we're trying to do is eliminate these extremes, still deliver the alpha and give you and your client a smoother ride, assisting you to maintain the client and the client to stay the course. I want to end off on our multi-asset funds, and I just want to show you the picture. A similar type of picture on this behavioral finance is, if I take our 3 main asset allocation funds, enhanced income, inflation plus, and balanced, all right? How does the monthly returns look? And if I put it in a distribution. So these are monthly returns since inception of each of these funds. So what can the client expect when they get into this vehicle? All right. So clearly this is a more conservative fund, but it still needs to deliver cash plus 2 over time. It needs to take risk to deliver that. Over time, only 1% of the months actually had a negative return. 98% of the months is between 0 and 1%, between 1 and 2%, between 2 and 3%, this is above 3. All right. So the expectation that the client will have when they get into this fund, again, this is the history, hopefully the future, don't know how it will look like, but over a very long time, this is the experience that this fund has delivered. Clearly, if you go to only 1% less than, and I think that with 2 months in particular, taper tantrum and then a gate. If I were to take inflation plus, clearly now I need to take on more risk. This fund needs to deliver inflation plus 5% over time. All right, so you need to hold up to 40% equities. You would expect a wider distribution around 0 in a given month. And what we see here is that 65% is between the 0 and 2%, 26% above 2, and 9% is less than 2. I would argue that this is a very smooth ride for a fund with that amount of risk in it. You guys are well aware of the performance of these funds. I'm not going to go into that. These funds deliver on those mandates. Going to the balance fund, obviously a lot more risk, inflation plus 7 odd before fees. Over time, you would see a wider return distribution, and again, you would probably see more negative months, 20% negative months, 80% positive months. I would argue for the level of risk that that fund needs to take and delivering on that mandate, that's actually quite a good return distribution, i.e. your client will experience a fairly smooth path for that level of risk that they take. reduce that number of surprises, reduce the difficult conversations that you and your client have. Thank you very much for your time. What I thought about, again, this is how we try and manage money. We don't try and out-forecast everyone, but most importantly, we try and take these known factors and we try and implement them, not only putting the bets on the table, but implement them on a risk-conscious basis to deliver to you and your client over time.